Hello and welcome to Prime Investors channel. Today we are going to discuss about an index that has been in the limelight for over a month now. This index is the Next 50 index, the Nifty Next 50 index, and it was in the limelight because it got severely hit due to the fall in the Adani stocks, in which it had quite a bit of weight. But once this fall happened, most investors, started questioning the wisdom of investing in the next 50, and also the wisdom of investing in an index fund itself. If an index fund can have, stocks with governance issues or quality issues, what's the point in having an index fund? Now, I'm not going to get into the details of the wisdom of investing in an index fund. Rather, today our discussion will be about the next 50. The next 50, to understand whether you need to invest in this index or not, you need to understand how it works. Um, Unlike what most people think, the Nifty Next 50 does not really consider fundamentals, the stocks fundamentals when it comes into the index. It's just the next 50 stocks after the Nifty 50. The Nifty 50 consists of the largest 50 stocks, and this is the next 50. The emerging, Nifty 50 stocks is how they were, called earlier. And for a large part of this index's life, they lived up to the expectation of generating high returns as a stock moved from being a mid cap stock to a large cap stock. So it was an emerging large cap, index that housed stocks that were growing in size. And that's how its returns became quite popular. Its performance became quite popular, and a lot of, portfolios did have Nifty Next 50. But to understand why the Nifty Next 50 can be quite volatile as an index. Forget what happened in the Adani, episode. Even without that, the Next 50 can be a very volatile index. And to understand how this volatility comes from, you need to understand the constituents of the Next 50 index. And we have written as a team a very detailed article on this, the link for which you will find below. I'm going to just take a gist of this and explain, the construct of this index, and this will be of use for those of you who want to do passive investing, and those of you who think passive investing, beats active investing, or it takes the entire wisdom of fundamental investing into account. You need to understand how the index works. So let me get into it right away. First thing that you need to understand is, the next 50, basically, like I said, is the next 50 stocks outside of the top 50. So typically these are stocks that are fast moving from the mid cap. They have grown beyond the mid cap and may become the next Nifty stock itself. So as they grow, they come into this index. If they really, grow well, they make it to the Nifty 50. If they kind of remain sideways, they remain here. If they fall, they may move to the mid cap index, right? They may even fall out of the mid cap index if they do really bad. We'll talk about that. So that's where it is. It's between the mid cap index and between the Nifty 50. So it's like it houses the stocks in between. So we need to kind of, understand that this index is a high churn index. Just to put it in context, in the last 5 years, as our data here will tell you, about 104 stocks in this index got churned, right? That's an average of about 20 stocks or 40% of the 50 stocks that get churned every year. That is very high, considering the Nifty 50's churn is very low. Nifty 50 saw about just 41 stocks in the last 5 years being churned. Now look at the difference. So this is a high churn index. Some fund managers do this high portfolio turnover. Similarly, this index has a high churn. So because of this, we will constantly see stocks coming in, getting out, etc. And remember, it's not always easy for stocks in this to move to the Nifty 50. The Nifty 50 is the largest, right? So unless there are few stocks that really fall out because they're not doing well, or there are stocks that have really done well in the next 50, it's not easy making it to the next level from the next 50 to Nifty. So it's not always that you have stocks that zoom to the Nifty 50. To that extent, you should know that there can be stocks that just stay here whose performance might be okay, but not really great to make it to the Nifty 50. And this is where my colleague who wrote this article calls it, a gateway plus a recycled bin. Stocks moving into the Nifty 50, if you see, we have quite a few stocks mentioned here in the last 5 years. Divis, HDFC Life Insurance, because these are also newly listed stocks that came in and made it big, right? Tata Consumer Products, Adani, as you will know, all these moved into the Nifty 50 from the next 50. That means their market cap grew so much that they made it to the largest of the large, in the Nifty 50. Remember, the reverse is also true, that there are stocks moving out of the Nifty 50 into the next 50. When the market cap slides, the erodes, the stock corrects sharply, and there are others coming in, then they get pushed out. Such stocks, for example, are HPCL, Hindustan Petroleum, India Bulls Finance, Lupin, Yes Bank, of course, after the episode, the big episode that happened. So these stocks also get pushed. So what you need to remember here is that the poor performers of Nifty 50 can come into the next 50, and they may or may not improve. If they continue to do badly, they will hit the performance of the next 50, and this is what we say when we say causing havoc before exiting. So once it comes to the next 50, sometimes you could have low returns, flat returns, really pushing the performance to nowhere. And that's exactly what happened in the last few years. And that was compounded by many of the new IPOs that also came into the next 50 directly with very high valuations. Let me first look at some of the stocks, that weighed on the Nifty Next 50 before moving out. You will see here Pyramid Enterprises, L&T Finance Holdings, sale, etc. These have been really pulling down. You see the returns here all in double-digit losses. Returns have really pulled down the Nifty Next 50's performance, and they have moved out of the next 50. And then there are these IPO entrants that big time pushed. In fact, they are one of the primary reasons why the next 50. In the normal course, you would expect the mid cap stocks, they are growing, they come to the next 50 and they really continue to grow, making it to the large cap, kind of, even if they don't enter the Nifty 50, they become large caps, and there is a market cap value add, the accretion that happens in the market cap. But here you will see that these stocks that made it to the next 50 through IPOs really eroded in terms of market cap, and that again pulled down performance, especially in 2022. These stocks that came in, many of them FSN e-commerce, Zomato, you will see all the big names. All of these 197 communications, which is just about, positive. But you will see that they all eroded, much of these stocks eroded the returns of the next 50. So what happens essentially is that the stocks coming into the next 50, it's a matter of the quality of the stocks that come in, which the next 50 has no control over. So if you have really quality mid caps coming into the next 50, they perform. Like we said, we showed you, some of the stocks at the beginning, the V's, HTV, they really performed and they even moved to the next level of the Nifty 50. But then there are also stocks that pull down, and these new age e-commerce companies that came in 22, one of the primary 21, 22 primary reason was a primary reason for coming with high valuation directly into next 50, not being able to sustain those valuations because they could not perform, and then pulling down the returns. We don't see this kind of huge hits in such a short span. Please remember that. And that's one of the primary reason why the Nifty Next 50, really fell sharply. And then came the Adani in 2023, the Adani stocks, they had quite a bit of weight. The next 50 had Adani Transmission, Adani Green, Adani Total Gas, apart from companies in which it holds stakes like Ambuja Cements. So these stocks, basically had a weight of about 9%. If you include stocks like ACC and Ambuja, that's 14%. Now that, again, the hit in these shaved off the returns of the next 50. But do remember, when these stocks fall, their proportion in the next 50 also comes down. So to that extent, you should understand that it is an auto-correcting mechanism. Those that don't do well just dissipate, fade away, get out of the next 50. or they continue there with lower weights, because as the market cap comes down, their weight, they are all market cap weighted, please remember, the weight also comes down. So you should basically understand that stocks come in with their strength of market cap and not with the strength of corporate governance or earnings and so on. So if market cap grows, assuming that it is supported by earnings, they do deliver well. If market cap grows without the support of earnings in the medium to long term, they don't deliver, right? So this basically is an auto-correcting mechanism in any market cap based index, and that's exactly what the next 50 is also going through. So if you want more details about what you should do with the next 50, how should you kind of hedge your high risk exposure to next 50 with other investments, etc., do read our detailed article, the link of which is given below. And you can also check how to build index based portfolios with our recommendations in prime funds or our ready to use portfolios. Do check them, and do also subscribe to the Prime Investor channel to learn more. Thank you.